Good morning and good afternoon, everyone. Thank you for joining us. This is the Preparing for Your First Plan Audit webinar hosted by Pension Assurance. Today, you'll be hearing from me, Christopher Beckett, and Alex Sanchez. A little bit of background about Pension Assurance. We are a single service accounting firm, and what I mean by that is that we focus solely on benefit plan audits. 100% of our firm revenue is derived from auditing benefit plans, and we have about 40 individuals that have dedicated their careers to learning about and auditing retirement benefit plans. We don't do any tax work or corporate financial statement audits. Our entire year is spent in the employee benefit plan audit space. This year, we're expected to audit over 600 plans, which has grown since 2014 from about 100 to 120 to where we are at today. Before we move on, I wanted to share with you the vision of our firm. We want to become national leaders in the area of retirement plan audits, in quantity, quality, and subject matter expertise. And our mission is to deliver value and education to our clients through our retirement plan audit process by cultivating a team of experts that provides the highest level of service and efficiency for our work. Today, we are going to be talking about when a plan audit is needed, how to select a plan auditor, a little bit of information on the DOL audit quality study, the documentation needed during the audit, how your plan service providers can help with the audit process, common audit findings, and the audit timeline. So jumping right in, how did this happen? Why do we require an audit this year compared to last year? Well, that is largely driven off of your beginning balance participant account, beginning participant accounts, little asterisks down there. Any participants that are eligible, active in the plan, terminated or retired with account balances are included in that participant account at the beginning of the year. So you may be finding yourself with 15 people actively participating in the plan, wondering why you're subject to this audit requirement. Is because it also includes those other categories of participants. To be considered a large plan, generally you need more than 100 participants, but this does not necessarily drive the audit requirement. The biggest caveat to that is the 80-120 rule. And what that says is that if you're between 80 and 120 participants, you can file as the same filing that you did last year. For instance, if you were a small filer below 100 participants in the prior year, this year you've moved up to 105 participants. Because you are within that 80 to 120 count, you can choose to file again as a small filer in the current year. And then that continues to happen up until you eclipse the 120 participant count. If you think about it, go from 105 to 115, I can still file as the same as last year. And then once you break into the 120 and above mark, now you are considered a large filer and are required to have the audit regardless of your previous year's filing. A small exception to this is if there is a new plan that is incepted in the current year and they have over 100 participants upon inception, they would require an audit because there is no previous year's filing to fall back upon. Another question that we get regarding this participant count is, well, I had a merger during the year and my participant count jumped from 80 to 150. Unless that merger happened on January 1st, the beginning of the year, those participants would not be included in that beginning count, and therefore the audit requirement would be pushed off until that following year. So just to reiterate, that definition of participant includes eligible participants that are participating in the plan, eligible employees that are not participating, and then those terminated employees that have left an account balance in the plan. That right there is a good way for service providers to help out as well, is if they notice that there are a number of terminated participants with account balances, there are rules within the plan documents that allow them to be pushed out into an IRA or be sent a check if the amount is small enough, and that can help keep your plan count lower for a longer period of time. Moving on, how do we select a plan auditor? If CPA is behind the name, doesn't that mean that they're all the same? Generally, no. There are a number of different expertises that CPAs can take. Tax work, corporate financial statement audits. In this case, employee benefit plan audits is our specialization. And this area has and continues to become a more technical and regulated area. Many CPA firms are actually exiting the retirement plan audit space due to regulatory pressures and increased scrutiny on retirement plan audits. The DOL does audit CPA firms from time to time, and it is important to make sure that any CPA that you're choosing is passing these inspections. CPAs are also required to undergo peer reviews, which does include their benefit plan audits. This is another thing that we advise asking for when going out to bid for a retirement plan audit. Peer reviews have become extremely strict in recent years, making sure that an auditor is being held accountable to the regulations for their audits. Next, the Department of Labor has done several studies over the years regarding the quality of audits. Their most recent study back in 2014 found that their overall deficiency rate for retirement plan audits was 39%, which is a jump, obviously, from years prior. This has been a great marketing piece for us and has reinforced everything that we believed when starting this firm, is that, you know, this is really a specialized area that needs to have individuals that are dedicated to this space to really bring the best level of service to their clients and the best expertise when conducting the audit. This study looked at work proficiency and whether the CPAs were following the audit guides. Another piece here from that study that they found is that in this case, quantity does have a correlation with quality. The number of audits, as you can see on the left there, when performing anywhere under 100 plan audits on an annual basis, the level of deficiencies was extremely high. You know, even up to 25 plan audits, still a 40% deficiency for those retirement plan auditors. What that means is that firms that are doing this as part-time work or summer filler work, when the corporate financial statements have concluded or tax season is at a lull, they're finding that these auditors and these accounting firms are having a harder time providing proficient and effective audits for their clients. Where we really see the audit quality pickup, though, is that 100 and over mark. And again, 12% deficiency probably doesn't look good, but it's definitely above the other categories in that area. What's important is that you have an auditor, at least in looking at this graphic here, that is committed to doing a volume of retirement plan audits. This means that they would have the training, the infrastructure, the program, staff, teams, and they stay on top of regulations throughout the year. Why do we care about that audit quality study? Well, the plan sponsor has fiduciary responsibilities to surround the plan with competent plan support, and that includes the retirement plan auditor. CPAs aren't really penalized too heavily for providing an insufficient audit, but the DOL can and will go after the plan sponsor. And the biggest thing with this is that they can reject the filing and require another qualified audit for that rejected filing. And this means that the plan sponsor is going to have to undergo the entire audit process a second time, and most likely have to pay for those second year or that second audit fee as well. So it's really a big hassle, can cost time, can cost money. You want to make sure that your auditor is providing proficient audits. We've taken over a number of these audits in the past because the Department of Labor has rejected those previous filings. And again, it's just really a hard point for the plan sponsor to be in, having to go through that a second time. Now, what information is relevant when picking a plan auditor? Oftentimes we receive requests for proposals that are anywhere between 3 questions long and 15 pages long. On the shorter end there, they ask for contact information and price, and that's really the only information they're looking for. And then on the opposite side of the spectrum, the 15 pagers are very extensive and may be more information than what's necessary to pick, but it's good to have a good balance between an effective and efficient RFP process. If anyone's interested, we do have a template RFP that can be shared as well with relevant questions to ask plan auditors. That being said, price is still important, especially when audit fees are paid out of plan assets, but you also want to look at the qualitative aspects as well. What's the commitment by the firm to benefit plan audits? Do they understand ERISA? Are they going to help you improve the processes that surround your plan? A number of individuals may look at a benefit plan audit as a commodity, but we really look at this at Pension Assurance as a way to help educate plan sponsors, to help ensure that their plan is operating effectively and within the rules and regulations and confines of the plan document. Lastly, it's okay to gather multiple proposals, and it's very important as a plan sponsor to document your decisions in writing to show that you have performed your fiduciary responsibilities in regards to picking your benefit plan auditor, as well as other service providers that surround the plan. Now, you've hired an auditor and you're getting into the audit process. You may see, and most often you will see, a limited scope audit. 90% of all audits are limited scope audits. This terminology may change a little bit next year, but the overall effect will stay the same. On a typical audit, an unqualified opinion is what you would see in a best case scenario, meaning everything looks good and is accurate as presented. With a limited scope audit, it's just saying that the auditor didn't look at everything that they would normally look at to create a unqualified opinion, which is usually not a positive. But in the employee benefit plan audit world, the DOL states that a limited audit is acceptable. And the only portion of the audit that's not being looked at is the asset valuations and the earnings that have come in for that year. Typically, these assets are held by qualified institutions, and these entities receive so much oversight and regulation at the federal level that it doesn't quite make sense for hundreds or thousands of auditors to re-audit those valuations and earnings on those assets. Hence, why benefit plan auditors, if they receive a complete and accurate certification, are not required to audit that information. Everything else, though, at the participant and plan level, is subject to evaluation during the audit, and this includes contributions, distributions, loans to participants, any compliance information. All of these are aspects that are being looked at in the audit. The main thing about the limited scope audits, though, is that with the exclusion of testing over investment valuations and earnings throughout the year, this allows us to create very efficient and effective audits, keeping costs and time low for plan sponsors and the auditor as well. And that's what you'll see for the most part. Okay, Alex.
Thank you, Chris. So this is Alex. I'm going to talk about how we can leverage service providers, go over the PBC audit schedule and what it looks like, talk about some new things, but here we go. So how do we leverage service providers? We try and do that as much as possible just to alleviate some of the stress on the plan sponsor side. I'd say by the end of the day, about 75–85% of the requests that we make flow through the service providers just to streamline things as much as possible. So depending on the service provider makeup, if you've got a bundled platform or an unbundled platform, you may not have a TPA in the mix. This is what we typically get from our service providers. So the financial advisor typically will provide copies of the meeting minutes and may have a fiduciary folder containing other plan documents. The TPA will typically provide the Form 5500 along with the compliance testing results, and they may have plan documents as well. The record keeper will provide what we call the audit package, and that pretty much includes the trust reports, participant transaction records, things like that, the SOC 1 report, so internal control report. And the plan sponsor will typically provide the anything related to payroll, so payroll documents, a copy of the fidelity bond showing coverage, proof of coverage on the assets for the plan, and then also prepare a deposit schedule, which I'll go through in one of our follow-up slides. Here is a copy of our required documents. So this is a sample PBC list. This is part one. There's a second slide that goes with it that'll show the in instances where we have a first-year audit, which would be for the most part the case if you're going from small to large and it's the first time going through it. So let's scan through this document. Again, we try and leverage the service providers as much as possible by including them and looping them into this document. So you'll see columns for each person represented or each entity represented. So you've got first column is the plan sponsor list, and we try and NA things that don't apply as much as we can. Again, just to shrink the list and make it as concise and comprehensive as possible. The service provider in part one, service provider one is typically the record keeper that will go there. So that's why you see everything under the auditor's package section, items 7 through 12 really will come from that service provider. The TPA is if the TPA has access to the record keeper platform, they may sometimes provide that information as well. And then the advisor at the end, the final column, will typically provide the meeting minutes, and there are instances where they have the information as well. So again, we try and leverage service providers as much as we can. If they can provide more than half the list, then it's just less and less for the HR team and the plan sponsor to have to take care of. So that's what we try and accomplish just to make it as seamless as possible. Here's the second part of that list, and we'll talk about why we asked for beginning balance supporting information. But for our first year audit, we have these additional requests that we make. The prior year 5500 is typically something that we'll pull from the DOL EFAST website. So that's pretty easy to do on our side. So again, we try and just use our resources and our relationships with service providers to be able to extract as much as we can, just to shrink that list a little more. A copy of the fidelity bond, which I mentioned, complete payroll register. So these are registers, payroll information that we'll need as of the beginning of the year. So a prior year. So if we're auditing 2020, 12/31 calendar year end, we would ask for a 12/31/19 payroll register. And I'll explain why that is and why we performed some tests for the prior year in the upcoming slides. Auditor access to record keeper website. It's a huge thing that we try and accomplish right out of the gate. And that just helps us to be able to pull as much information as we can. And we don't need access to payroll change ability or anything like that. It's just an auditor access that that record keepers typically can provide, limiting what we see, what we can do, just so that we can accomplish what we need as it pertains to the audit. And then prior year trust statements and prior year non-discrimination testing, so we can get comfortable with the opening balances as we'll talk about further here. here's a sample deposit schedule. So this was one of the items that were listed on the PBC schedule. And this is typically something we'll get from the plan sponsor. And so the reason why this is important is because this allows us to test the timeliness of the remittance contributions. And so what we ask for is a compilation of the deposits that are made to the record keeper for the plan for the entire year. And it should include employee deferrals, employer match information, loan repayments, and that first highlighted section, the first 4 columns, is produced through your payroll register. So payroll information, you can pull that from your files, hopefully. Maybe you even have something similar that we can leverage that. So it doesn't have to look exactly like this, but we just want to make sure the information is in there. Sometimes we do run into situations where the plan sponsor already has their own template, and we're flexible in that, as long as the information is there, that's all that matters. The grayish columns that are there towards the end are compiled by using the trust reports, or the record keeper information, or bank statements. And the reason why you may have a variance is just because, well, there might be several reasons, but the main reason you'll see variances is due to forfeitures. So if you have forfeitures that you're applying against these contributions on the match, for instance, then you may see discrepancies there, and that's okay, because that's perfectly explainable and expected when you're using forfeitures. Beginning balance test work. So why are the auditors asking for prior year information if we're auditing 2020? We get that question for the first year audit at times, and it's really because the audit standards require us as auditors to do an initial evaluation of the opening balances and to gain satisfaction of those opening balances as to whether or not they're materially misstated. So we have to make sure that we're rolling forward the activity and that we're comfortable with those opening balances. And there's different ways to achieve that. We're able to achieve these objectives by determining whether the prior period's closing balances have correctly been brought forward to the current period when appropriate. And so that's why you'll see those requests for prior year information, determining whether the opening balances reflect the application of appropriate accounting policies. So just making sure there's consistency in the way everything is applied, so that our financial statements in the end are comparative, and that they're based on GAAP accounting accrual and not cash. So those are things that we look for, looking at cutoff, looking at things like that. And then evaluating whether audit procedures performed in the current period provide evidence relevant to opening balances and performing one or both of the following. So in this, for the most part, everybody that's on the call today is going through or about to go through their first audit. So bullet point 1 down below, C1, won't apply to you, but in instances where, let's say you've been audited in the past and you're going through transition to another auditor, that successor auditor should be reviewing the predecessor auditor's documentation to gain evidence of that opening balance. And they may or may not do that. We try and do that and leverage the fact that the work was done, especially if it was done by a reputable auditor, to be able to knock out some of the procedures that we have to do to get comfortable with those opening balances. So we'll coordinate that. We'll ask you for the predecessor auditor's contact information, and then go from there. And then the performing of audit procedures to obtain evidence regarding the opening balances. So if it's a first year audit with no audit performed in the prior year, we would revert back to that PBC schedule, request those items, and perform some testing to get comfortable with the opening balances that way. Common audit findings. So answers to the tests. Here's kind of like the cheat sheet. What do we see out there, and what are the problems that we're finding with these audits, right? So if you've been in the industry for a while, late contributions is something you hear about all the time. So you want to be consistent. You want to be consistent in the way that you remit your contributions. And if you, let's say, have a proven pattern of remitting those contributions between 3 and 5 business days, then the DOL wants to see that you're consistent about it. So they can come in easily through an investigation or a DOL audit and say that because you've proven that you have remitted funds between 3 and 5 days, for instance, and then they can call out easily a outlier or two. If let's say you have 1 or 2 out there that are beyond 10 days, even though it's not past the 15-day drop dead rule threshold, they can still call it out as late and have you cover, calculation to cover the lost earnings and interest related to those deposits. So you just want to be as timely as possible and be consistent about it, and you'll be fine. Not following the plan document. So the premise for tax qualification on the plan is based on the set terms of the plan document. So you want to make sure you're abiding by and operating the plan in accordance with the plan document. So definition of compensation is one thing. So if, let's say, the plan document reads the 401k deferral and definition of plan compensation is based on W-2 wages with no exclusions, then if that's the case, then we have to make sure that the payroll is functioning that way. So the payroll codes that are feeding into the 401k deferral calculation should mimic or emulate what the plan document is saying. So if they're saying that bonuses should be included, you want to make sure bonuses are included for payroll as well, commissions, and all those codes that feed into wages, basically. And so that's one thing that's major, and it could become costly if you're not following that, because it could turn into just an expensive correction, especially if it's something that has been hanging out there for a while. One of the times to check on this definition of compensation is, especially when you're switching payroll companies, that's usually a risk, time of risk there when you're going through a payroll change, platform change, anything like that. You want to make sure that those payroll codes are right, not only for the 401k, but really for all benefits. But especially here in the 401k, since we're talking about it, it's definitely a big one. Eligibility, so not following the plan document in terms of eligibility, and then vesting as well. You want to make sure that if the plan document says 3 months of service, that people are getting enrolled as soon as they're eligible, or you're giving the option to enroll as soon as they're eligible. Not following the participant's instructions, definitely a big no-no. You want to make sure that as employees are making their requests, whether it's through paper form or online, that payroll is getting that information timely so that they can do their part to process those requests and information on a timely basis. Missed enrollment and auto enrollment plans. So this is something we see often, especially with auto enrollment being more popular these days. And so that's something that you have to make sure that your payroll, again, is aligned with the plan document and that people are getting auto enrolled as soon as they're eligible. Audit timeline. Here's what it looks like. Typically, we say that it takes about 6 weeks from the time we receive the audit package to the time we issue a draft of the financial statements. So this is what that looks like. And there's flexibility here for sure. So as things happen throughout the process, we would communicate that back and forth. If, let's say, there's a project internally from the plan sponsor side, we can definitely tweak things to make sure that we're accommodating the plan sponsor. But for the most part, here's what it looks like. So week 1, we obtain the audit package, we send out our audit selections, and schedule a date for remote field work. So we especially in this environment with remote work, we are doing that more and more. So we try and over communicate as much as possible to make sure that we line up resources accordingly. Because sometimes, out of sight, out of mind. So we just want to make sure that we're communicating when that remote field work is going to happen so that we can align our resources accordingly. Week 2, perform analytical procedures, build out work papers, document internal controls, and draft financial statements. Most of that is done internally by us. The only interaction with the client there, or with the plan sponsor there, that should happen is the documentation of internal controls. Typically takes about maybe half hour, 45 minutes to go over the processes as they relate to how you make contributions, how you process payroll, how you process distributions, things like that. Talking about the controls as they relate to access to the record keeper website, your payroll. Those are things that we have to gain an understanding, and we try and do that early on in the process. So that's why it's here in week 2, so that it can basically set the tone for the audit and our audit approach and our own internal risk assessment to go over our thresholds with regards to how we're going to approach the audit, selection, population, things like that. Week 3, once we've already sent out, we'll go back to the timeline. Week 3, when we go back to the audit selection, so we send out the audit selections. Week 3 will address any questions that may come up. So that's now everything is on the plan sponsor's plate. So if there's any questions, we can do that, go over anything, and then it's kind of a waiting game. It's kind of a dance, because it's like, well, first hand things off to you, and then you go back to us with information, and then we process the information. We might have some follow-up questions, and so that's happening typically during weeks 3 and 4. And then weeks 5 and 6 towards the end, that's when we're performing the test work. You've already provided the information that we need to perform that test work. And then we close out any follow-up issues that might be hanging out there. Internally, we'll perform a second review for every audit that gets performed and send out the draft financial statements for your final review and ability, and then review and then approval at the end, so that we can final it for you. Major correlations with audit quality. So Chris had talked about the just the importance of the DOL study and what it entailed, and the correlation of audit quality versus experience. And so these are the factors and how we kind of stack up, just to kind of give you a sense of where we are. So factors correlating with audit quality: audits more than 100 plans annually, as Chris stated earlier. We do have over 600 plans that we audit annually now and growing. Greater than 10% of the firm revenue from plan audits. Because this is a specialization of ours and all we do, and we're a single service firm, it's 100% of our firm revenue. So, there's no other sources of revenue or other industry niches that we're in that compete with this internally from our standpoint. Members of the AICPA Employee Benefit Plan Audit Quality Center. Yeah, definitely a mouthful, but you want to ask, if you're going through an RFP process, if the CPA is part of that audit quality center, because it shows that they're devoted to the craft and devoted to the industry, and really it's another resource for them. So definitely something a CPA firm would want to have if they're specializing in this industry. And then engagement partners, more than 24 hours CPE annually, and employee benefit plans. Because this is all we do, majority of our CPE is all EBP related. So we basically crush the 24 hours, because we're required to get 80 hours overall as a CPA, as CPAs every couple of years. So majority of it is all in the EBP side. Leading the pack. Okay, key differences that set pension assurance apart. So we hire experienced professionals, so you're not working with an intern directly or a first-year staff to get these audits completed. Oftentimes, when you run into a full-service firm, you might see the EBP practice used as a training ground for interns and staff, and so they're the ones who are running these 401k audits. But with us, because it's all we do, we don't do SEC corporate work or tax work. This is 100% of our focus and attention is on this. So, so you're working with a 4 or 5 year type experience individual, a manager for the most part. And so you're going to get that knowledge and experience when you're working with somebody hand in hand on this audit. And so you're going to learn more along the way. Industry competitive fees. Because we do over 600 plan audits, we're very efficient at what we do. So fees are competitive given the expertise that we bring. Efficient and streamlined audit approach. So again, talking about how we streamline with the different service providers. That allows us to be able to just be efficient. And the fact that we do over 600 audits as a firm out of one office, it allows us to, we've seen everything. We've worked with all the different record keepers. We've worked with different payroll platforms. So we've run into the situations that you're most likely dealing with. And so it's not, as things come up, they don't tend to stall things for the most part because we've seen it. And then exclusive focus. Everything and everyone in the firm is focused on plan audits. So you've got our highest level of commitment when it comes to this practice. And then what's new? So these last couple of slides, I want to go over the CARES Act and Secure Act and just talk about how it impacts audits, right? So we've heard about it. We know it's out there. So how does it affect what we do on the audit side? Partial plan terminations is one thing I wanted to talk about. This is something that hasn't been as prevalent as it has recently, just because of COVID and the fact that there were some significant layoffs and involuntary terminations in 2020. So the CARES Act has provided for some relief in this, saying that a plan shall not be treated as having a partial plan termination during any plan year, which includes the period beginning March 13th, 2020 and ending on March 31st, 2021. And if those dates ring a bell, it's when there was an emergency order put into effect. So they're basically saying if if your head count is pretty consistent, and you're at that threshold from beginning of March to end of March of 2021, so beginning of March 2020 to end of March 2021, then you could, based on that analysis, not have a partial plan termination. And just to give you a sense, for those that don't know, or maybe this is new to you as far as what a partial plan termination is. So if you've got more than 20% of a turnover ratio when it comes to your head count, based on your involuntary terminations. So if you've had massive layoffs and it turns into over 20% turnover ratio, then you've got a partial plan termination possibly in the midst. So saying that, what happens when you have a partial plan termination? So if that's the case, what ends up happening is that anybody who's involuntary term that falls into that category goes into that calculation of the 20%. But if it's determined that partial plan termination does exist, then those people who are affected by the partial plan termination would automatically be 100% vested in their account balances. And that includes the employer match, profit sharing, employer contributions in general. So if I were part of the company, had only worked with the company for a couple of years, only maybe had 20% vesting. If I was part of that layoff and the plan falls into that partial plan termination, I'd be 100% vested right out of the gate. And that affects not only involuntary terminations, but those that were terminated during that 1 year span. And so typically the analysis goes, it's generally based on a 1 year period. And so that's why this relief says, okay, based on the timing of COVID and the CARES Act, this is what we're doing. And you can analyze it this way based on what happened with COVID and the CARES Act just provides that relief to be able to use a different cutoff instead of January and December. Late employee contributions. So that's another thing that came with the CARES Act. So it gives a little flexibility. If let's say you had issues with COVID and with lockdowns and everything and had an issue with some deposits during this time span, specifically beginning of March of 2020 and ending on the 60th day of the following that announcement of the national emergency, then there's some relief there for you. So if you see that you had a consistent pattern the rest of the year and it was just an issue during the 60-day period because of COVID and providing an inability to timely remit on a consistent basis like you had the other parts of the year, then there's some relief there for you as well. And then the Secure Act. So on the Secure Act, this really affects if you have long-term part-time employees. So starting in 2024, anybody who is a long-term part-time employee beginning in the calendar year of 2021, you have to keep track of, so this year, keeping track of the hours is very important. If you've got long-term part-time employees, a participant who works between 500 and 999 hours per year for 3 consecutive years, and who is otherwise not an excluded class of employee may participate. So the problem here lies with administration, right? So if let's say you're not used to keeping track of the hours because you've got a few part-time employees and you're not sure, you know, whether or not they fall under this category, tracking the hours now is very important. So the Secure Act no longer permits plan sponsors from excluding all employees who work less than 1,000 hours. So that's why this is important. The couple of notes there in the middle of the slide, plan sponsors may still exclude part-time employees from receiving match contributions. So that's still something you can customize in your plan to do. Vesting would also include the years the employee was working between 999 hours as applicable. And then plan sponsors may permit part-time employees to begin participating at an earlier date. So if you want to amend the plan, that's something that you can do as well. And we'd recommend it if you're worried about the administrative load. It just reduces that if you just amend the plan and say, okay, we're now going to allow part-time employees to participate in the plan. That way, you know, it alleviates you from having to track those 3 years, and you can still track it, but by amending it, you're basically being more all-inclusive and saying we're just going to allow part-time employees to participate to avoid, you know, running into issues here. And then plan sponsors must amend their plans for the Secure Act by the last day of the plan year, beginning on or after January 1st, 2022. So you've got some time there. And that just about does it. There was a question regarding the audit quality study by the DOL. We will definitely send that your way. No problem there. And then take this time. We've got contact information for both Chris and I on here. Feel free to just bring out your phones. You can scan the UPC or the QR code on the screen so that you can get connected with us on LinkedIn. You've got our contact information, our office line down below, along with the website and our LinkedIn page as well. Definitely feel free to ask questions. We've got, let's see.
Yeah, Alex, any questions or any requests for slides or information from this webinar, please feel free to email Alex or me about that. We had one specific question about plan corrections. How expensive are they, and do we help with plan corrections?
Great question. So Cal, to address that question, you've got a wide range of plan corrections that are out there. So it just depends on what the issue is. If we're talking about definition of comp, or if we're talking about timeliness of remittances. The timeliness of remittances, which is a prevalent one, if you correct it as soon as you can, it's typically not a lot, because you go through the calculation and you test, or you figure out what the lost earnings are on the timeliness of when you made the deposit to when you kind of should have made that deposit based on your history. It doesn't end up being a lot, but with that case, it ends up going onto your 5,500, and it gets tacked on as a supplemental schedule on the financial statements. So it does end up on the DOL's radar, I guess, because it's public information, and so you want to stay away from it from that perspective. But from as far as the compensation, definition of compensation, that could be a big issue if, let's say, you're excluding bonuses, for instance, from that calculation, and you've got massive bonuses that get paid out every year. If you're talking about, you know, average 5% deferral on contributions, and you're, you know, you're in the millions when it comes to these bonuses, then it can definitely add up very quickly because it's considered a missed deferral opportunity for all your employees that it affects. So it just really depends, and there's also different ways to correct errors, operational errors. Sometimes they're not costly at all, where you can actually, depending on what it is, retroactively amend a plan to correct in certain situations. If you ever run into a situation where you're unsure as to how to approach a correction or how to address it, you can always engage an ERISA attorney as well to help out with that process. We've got an in-house legal counsel that we refer to whenever there's questions that pop up that you can use as a resource as well. So that's something that we've got at our disposal as things come up as well. Thanks for the question. Perfect. Well, if there's no other questions, feel free. Again, you've got our contact information. Reach out whenever, and whenever something comes up, feel free to use this as a resource. Thank you so much for taking the time to join this webinar. We appreciate you wanting to learn more about what we do and going through your first audit. I hope that it's a pleasant experience for you if you're part of that group. Our biggest, we're happy when we hear after the fact clients say, you know what, this first year audit was a cakewalk, and I was stressed out about it, but you made it better than it could have been. So that's usually the best compliment that I personally and we as a firm like to get, and we want it to be as educational as possible. So it's more of an enjoyable process, as much as enjoyable as an audit can be. So thank you again for your time. Have a great rest of the day. Thank you again for joining. We'll talk to you soon. Take care.